Okay, welcome in. You're listening to the weekend edition of the Korelin Economics Report. Opening the show this week from the Cambridge House International Investment Conference, which is located here in Vancouver, British Columbia, with an old friend of mine, Lawrence Roulston. Lawrence was actually on the show last week, but I wanted to, a lot of things were left unsaid in the segment that Lawrence and I shared a discussion in, and one of the things had to do with the situation in China. Now, one of the events at the conference here was a debate between a gentleman named Gordon Chang and my friend Frank Holmes as to how bad is the situation, or in fact, is it really bad in China? And I know Lawrence and I agree with the fact that it really isn't bad at all, not even close. Why don't you start out?
Well, there's a lot of concerns about China. There's no question, human rights and, the demographics and every other reason to be negative about China. You can find any number of reasons to talk negatively about China. But from my perspective, and I think from your perspective, Al, and many of the people listening to this show, what we're concerned about with regard to China is not what's going to happen to their human rights, but are they going to continue to consume resources?
Exactly.
And that's from
Not that human rights isn't an important issue.
Oh, no, absolutely.
But we're talking economics here.
There's an incredible amount of very important issues with regard to China. But the really important variable that we need to focus on is, will the economy keep growing, and as such, will they continue to consume resources? And, I sat through the debate, I listened carefully to both sides of it, I've followed China, and as you know, I've been there and looked at it very closely from a number of perspectives. There's not one bit of evidence that the economy is not going to continue to grow. And as long as the economy is moving along at anything like the pace that it has been, they're going to keep consuming resources. And that's really the key variable here.
Let me throw one thing out at you. One of the arguments that I'm hearing, and I haven't spent any time in China, you spent a lot of time in China, but one of the arguments that I'm hearing is that the real estate sector is so tremendously overbuilt there. There are a huge, huge number of vacant office buildings, vacant dwellings, etc. And people are taking that to the next step, which is that's a bad sign and is going to bode ill for the economy. What do you think?
There's been a lot of talk, there's been a lot of anecdotal evidence, and I know that I have been to shopping centers that were just opened in years gone by where you could fire a cannon down the aisle and not hit anybody.
Right.
And then I've gone back a year or 2 or 3 years later, and these things are just full of people. I think one of the key things here that people lose track of is that the Chinese have a much longer term investment perspective than people here. 5 years ago, 6 years ago, 7 years ago, there were stories of empty office towers in Shanghai. And because there were empty office towers in Shanghai, the whole economy of China was going to collapse because there was overbuilding. Well, those office towers are now full. They've built more, those are full. And anecdotal evidence, one of the statistics that's quoted is that there are apartments that are not being lived in. Well, I happen to own 3 houses, and I'm only living in any one of those houses at any one time. Anybody could say, well, 2/3 of the real estate is unoccupied. And I think there's a lot of that happening. People in China now are getting second houses and third houses. They're getting real estate in investment properties. So the overbuilding argument is way misstated. And one more really important thing here is, you think back to 2008, the American government tried to put in place a stimulus package. They invested in excess of $1 trillion to help stimulate the economy. At the end of the day, they saved General Motors, they saved some of the banks that perhaps should have fallen, and there wasn't a lot of tangible evidence of that $1 trillion. China invested a similar amount in stimulating the economy, and some of that was misspent. There perhaps has been some infrastructure that perhaps shouldn't have been spent. But I think they got a lot more out of their stimulus than did the Americans, for example.
Well, what I think to be really interesting about the U.S. stimulus, just a couple of comments on that. Number one, in terms of bailing out General Motors, there are dealers Chevrolet dealers who do not want to take delivery of this new wonder car, the GM Volt, which I think is kind of interesting. I don't think the stimulus package in the United States really, it saved a lot of jobs and it bought a lot of votes, there's no question about that. But in terms of long-term solutions, in terms of something that would not require more fingers to be stuck in the dike, for lack of better terms, the stimulus really hasn't done very much.
No,
in the United States.
The U.S. economy is still struggling, and the Chinese economy quickly snapped back to 9 or 10% growth after a brief slowdown in 2008. So if they didn't get 100% payoff on the infrastructure that was built as part of that stimulus package, well, you know, they've got a much better track record than other large economies that tried to bail out their economies.
You know, interestingly enough, when you look at mainland China and you say we're concerned here with the financial aspects of it and not the social aspects of it, you know, I want to stress that. But secondly, the interesting thing that mainland China brings to the table, Lawrence, and this is something that you and I discussed on the show last week, and that is, boy, we have an industry that's really out of favor. It's called base metals, as a sector, I guess I should say, the base metals sector. And I have to tell you, when you look at the amount of increasing demand that is going to occur out of an economy that's growing at arguably somewhere between 8.5% and a 9.5% rate, I question why base metals are out of favor right now, from an investment standpoint.
Well, it's purely psychological. People are fleeing risk. They've got this negative perception in mind, and you know, they're not really taking a longer-term perspective on it. You know, if you look at the copper price over the last few weeks, it snapped back pretty significantly. Copper price on a longer-term perspective, the copper price is up fivefold over the past decade, which is exactly the same ratio that the gold price and the silver price are up over the last decade.
That's an interesting point. Very true, yeah.
And what it says is that demand for all of these metals is continuing to grow. And if we have a brief slowdown in one economy or the other somewhere in the world, it doesn't impact the long-term growth profile for all of the metals. And the other point that very few people really recognize is that the mining industry is changing dramatically to the point where, you know, the big high-grade deposits that were sticking out of the ground in decades gone by are gone. It's getting harder to find metals. And, you know, one tangible in that regard, you know, a typical gold mine in the 1960s had a grade of 12 grams a ton. Today, an average gold mine has a grade of 1.3 grams per ton. It just shows it's getting harder to find metal deposits. It's getting harder to find the big high-grade deposits. And therefore, on the supply side, there's going to be a continued constraint on the ability of the industry to ramp up production.
I know you're not an energy guy, and I'm not going to talk about the energy aspect of this next question to you, but an embargo was announced last Monday in terms of the European community, the UK, and the United States throwing an oil embargo on Iran. Now, the implications of that could be fairly dramatic. Any impact that you see that would have on the price of precious metals?
Well, it creates additional uncertainty, and the gold price certainly responds to uncertainty. And you know, we've seen an upturn in the gold price over the last few days. There may be a relationship there, but it's just one more element in an ongoing, highly uncertain world where investors are turning to gold as a long-term safe haven, a secure store of wealth. And
you know, as they rightly should. It's interesting. I'm going to be doing an interview here in the fourth segment of this hour with James Turk, a colleague of ours. Good guy. I think James is absolutely brilliant when it comes to his comments about the future of precious metals. James is very, very bullish for 2012 for what I think are all the right reasons. I think there are some very serious economic fundamental reasons that I have felt have been in play now for the past 5 or 6 or 7 years, and I agree with you 100%. I think that precious metals are going to do very, very well in 2012. Stick around, you guys. Big Al's going to be right back.